This video covers accounting for equity investments. Let's suppose we are accountants for Berkshire Hathaway, and our company is going to invest in Allbirds. In return for our money, Allbirds is going to give us ownership, so we're going to own a fraction of Allbirds. This is similar to like buying a stock in the stock market. You own a fraction of the company that you're buying stock in. That's what this is. That's what type of investment this is. So how do we account for this type of investment? Well, for accounting purposes, the percentage of ownership that we acquire determines the accounting method that we'll use. If we acquire between 0 and 20% of the company, we're going to use something called the fair value method. If we acquire between 20 and 50%, we'll use something called the equity method. And if we acquire between 50 and 100%, we will consolidate the company we invested in. First, let's talk about the fair value method when we acquire between 0 and 20%. When we use this method, we're going to set up an investment account when we make the investment. And that account is going to be held at fair value. So whatever the fair value of the stock is, we're going to hold that account at the fair value. Unrealized gains and losses that we experience when we're holding the investment are going to be recorded straight into net income. Likewise, all the dividends that we receive while we're holding this investment are going to be recorded straight into net income. So let me show you what that looks like. Suppose on January 1st, 2018, we buy stock in Allbirds. We pay $10 million and we get 10% ownership in the company. 10% is between 0 and 20%, so we'll use the fair value method. Here's the journal entry. This is establishing the investment account. So a debit to the investment account, which is an asset account, for $10 million, establishing the investment. The credit is to cash because we paid in cash. Now we'll go to the end of the year, 12/31/2018. Two things have happened during the year. First, Allbirds' total fair value has increased by $10 million. Second, during 2018, Allbirds had total net income of $1 million. So we are using the fair value method. So the part of this that we care about is the change in fair value. So here's what we'll do. The total fair value of the company increased by $10 million. We own 10% of that. So the amount that our investment increased is $1 million. We will increase our investment account to reflect the $1 million gain. So we debit the investment account for $1 million. It increases to $11 million. And the credit is to a gain account on the income statement. We recognize it in net income as soon as it happens. By the way, we can ignore whatever Allbirds' 2018 net income was. That's not relevant when we're using the fair value method. Okay, let's fast forward 5 days, January 5th, 2019. Allbirds issues a total dividend. They're going to issue a dividend to all of us. We're all investors. They're going to issue a dividend, and the total dividend is $1 million. It's distributed proportional to ownership. So we own 10% of Allbirds. The total dividend is $1 million. So the amount that we're going to receive as a dividend is $100,000. We debit cash for $100,000, and we credit a gain on the income statement account. And I call all these accounts gains and losses. Sometimes you might see this gain be called dividend income. Or something else. The point is companies can label this account many different things. That's why I just call it a gain on the income statement. But you might be seeing it called dividend income. Okay, so after January 5th, we go to January 10th, 2019. Now we sell the Allbirds investment for $11 million. Here's the journal entry. Remember that investment account was sitting at $11 million. It started at $10 million. Then we had a gain of $1 million, so it's sitting at $11 million. We're going to now receive $11 million for that investment. So we debit cash, receiving the cash, and we credit the investment account, reducing it to 0 and removing it from our balance sheet. And that's the trading method. Now let's go over the equity method. The equity method is when you own between 20 and 50% of the company. So you do an equity investment, and at the end of the investment, you own 20 to 50% of the company. What's the accounting treatment for that? Well, we're still going to have an investment account on the balance sheet. But rather than being held at fair value, it's going to act like a mini retained earnings account. And what do I mean by that? Well, the investment account is going to increase with our share of the company's net income. So our share of the company's net income is going to increase the investment account. Dividends are going to decrease the investment account, just like retained earnings. So remember, when we have net income, it increases our retained earnings account, and when we pay dividends, it decreases our retained earnings account. Well, when an equity method investee has net income, it increases our investment account by our share of that net income. And when they pay dividends, it's going to decrease the investment account by our share of those dividends, just like retained earnings. Finally, those unrealized gains and losses are just going to be ignored when they occur. So let's go through the example. January 1st, 2018, we buy stock in Allbirds. We're paying that same $10 million, but this time we get 25% ownership. 25% is between 20 and 50%, so we'll use the equity method. Here's the journal entry. It's the same as before. Debit the investment account, establishing the investment for $10 million, and credit cash because we're paying cash. Now that same year goes by. It's December 31st, 2018. Allbirds' total fair value has increased by $10 million, and Allbirds has total 2018 net income of $1 million. Since we're using the equity method, what we care about is their net income. We ignore the changes in fair value. So Allbirds has 2018 net income of $1 million. What is our share of that net income? Well, $1 million times our 25% ownership, our share in that net income is $250,000. So here's the journal entry. We increase our investment account with a debit of that $250,000. Our investment account increases with our share of their net income. And the credit here, again, is a gain account on the income statement. Sometimes you might see this gain account be called equity method income. Or something else. You might see this account be called something else. Okay, 5 days goes by. Allbirds issues a total dividend of $1 million. This is the same dividend. It's distributed proportional to ownership. We own 25% of Allbirds, and the dividend is $1 million. So we'll receive a dividend of $250,000. We receive cash, so we debit the cash account by $250,000, and we credit the investment account for $250,000. Now this credit decreases the investment account from receiving a dividend, and sometimes that seems a little strange, but let me put it in this way. We own 25% of Allbirds. When Allbirds pays out $1 million, we now own 25% of a smaller company, a company that has decreased in size by $1 million. That's why we're reducing the size of our investment by our share of that dividend. So we debit cash receiving the dividend, and we credit the investment account, reducing the investment account back down to $10 million. So remember, our investment started at $10 million with the equity method. They had $1 million of income, so it went up by $250,000, reflecting 25% of that net income. Then they paid a dividend of $1 million, so we have 25% of that dividend, $250,000, and went back down by $250,000. So our investment account is sitting at $10 million. So let's go forward one day, January 6th, 2019, and we'll sell this Allbirds investment for $11 million. So the investment account's at $10 million. We're selling it for $11. We're going to have a gain here. So here's the journal entry. The debit is to cash for $11 million. That's the amount we're getting for this investment. The credit, one credit is to the investment account for $10 million, reducing it to zero, removing it from our balance sheet. And we're going to recognize now this as a gain on our income statement. This was a gain that we previously ignored. We ignored changes in fair value. But now that we're selling the investment, we have to recognize this gain. Okay, finally, let's go through the accounting method when we acquire 50% to 100%. This is a major investment in a company, and we're using the consolidation method of accounting. This is going to be significantly different from the fair value method and the equity method. How do we do a consolidation? Well, we take all of the assets and liabilities of the company that we acquired, and we just plop them onto our balance sheet. And we do that at their fair values rather than we don't just put their balance sheet on ours. We assess the fair value of their balance sheet, and we put all of those assets and liabilities on our balance sheet. If there's a minority interest, we'll have to deal with that. A minority interest is when you acquire less than 100%, but greater than 50%. When the acquisition price, so the price that we pay for this investment, when it exceeds the assets and liabilities we identify on their balance sheet, we're going to record goodwill, which is an asset on our balance sheet. And going forward, we're just going to be treated as a single company. So whenever the company we invested in has revenue and expenses, those are going to be our revenue and expenses. They'll just be recorded on our income statement. So let's take a look at the Allbirds example. January 1st, 2018, let's buy stock in Allbirds, pay $75 million for 75% ownership. The first thing we do is let's see what we acquired. So here's the Allbirds balance sheet as of January 1st, 2018. And all these amounts are in millions. So we acquired $20 million in cash, $15 million in inventory, $50 million in PP&E, and $10 million in accounts payable. That's just what we're acquiring. So that's step one, is look at the balance sheet. Step two is to hire people to assess the fair values of all of these assets and liabilities. So yes, this is Allbirds' balance sheet, but what are all these assets and liabilities worth in terms of fair value? So we get experts to assess fair value. The fair value of the $20 million in cash is $20 million. That one's pretty simple. The fair value of the $15 million in inventory is $30 million. So the inventory, remember, is recorded at cost. It doesn't cost much to make those shoes, but what are they worth? Well, they're worth double, let's just assume. So the inventory is worth $30 million. The PP&E we acquire it's on their balance sheet at $50 million, but we think it's only worth $40 million, so that's its fair value. And the accounts payable, they say it's $10 million, and we agree, we think the fair value is $10 million. So those are the fair values of the items on the balance sheet. And what we do here now is just put all of these assets and liabilities onto our balance sheet. This is called consolidating the assets and liabilities. So this $20 million in cash comes onto our balance sheet. We debit cash, $20 million. The $30 million in inventory comes onto our balance sheet. The $40 million of PP&E and the $10 million of accounts payable. Notice that we're recording 100% of all these balances. Even though we only own 75% of them, we're consolidating them at 100%. And here's how we handle that fact. So we paid $75 million in this acquisition. That's how much cash we paid. But the implied company value is $100 million in total, right? If we acquire 75% for $75 million, the company must be worth $100 million in total. So the missing 25% is called a minority interest in those assets and liabilities that we acquired. And we record that in the equity section of our balance sheet. And what does that represent? That tells investors, because investors will see this minority interest account on our balance sheet, it tells investors, so you see all of the cash and inventory and PP&E that we have. We don't own 100% of that. There's a minority interest in those assets and liabilities. And that's what that account tells investors. Okay, so here's our journal entry so far. And if you add these numbers up, you'll see that the journal entry doesn't balance. Somehow we implied that the company's worth $100 million, but we can only find $80 million worth of fair value on their balance sheet in assessing it for fair value. So we're missing a $20 million asset. So why did you pay $75 million? What is that $20 million asset that you think is there? That's called goodwill. Goodwill does not necessarily represent overpayment. It just means that we couldn't find any specific assets to label it. We just call it goodwill because we don't know exactly what it is that made us willing to buy Allbirds for more money than the assessed fair value on the balance sheet. So that asset's called goodwill, and we'll talk more about that. Okay, going forward, after we've done this acquisition journal entry, whenever Allbirds has revenue and expenses, so they sell shoes, they create shoes, that's just going to be recorded in our income statement. When they sell shoes, that's our revenue. When they incur costs, those are our expenses. Likewise, on the balance sheet, their assets are our assets. Their liabilities are our liabilities. We are a consolidated entity. But that minority interest is always going to show up on the balance sheet, and it's also going to show up on the income statement. And it's a signal to investors so that they know that our company doesn't own 100% of those assets and liabilities. It'll also show up on the income statement. So the balance sheet and the income statement. It'll show up on the income statement to say, well, Allbirds had a lot of revenue, but we don't own 100% of that revenue. That's what the minority interest is going to tell an investor. Okay, so to recap, the ownership percentage determines the accounting method when you make an equity investment. If, as a result of the investment, you own between 0 and 20% of the company, you use the fair value method. The gains and losses that you experience are going to be reflected immediately in the income statement. And the dividends are also going to be reflected in the income statement. If we acquire between 20 and 50% of a company, we'll use the equity method. In that method, our share of their net income is going to be reflected in the income statement, and it's also going to increase the investment account. And our share of their dividends is going to reduce the investment account. Finally, if we acquire between 50 and 100% of the company, we'll consolidate. All of the accounts are consolidated onto our balance sheet, and a minority interest is created if we own less than 100%.